Okay, good morning, everyone. Welcome to Phillip Securities Research Morning Call. For today, we have stock counter updates for Monte Pacific, Keppel Corp, Keppel DC REIT, Frasers Centrepoint Trust, Microsoft, Netflix, and TDCX. And on the macro and sector outlook, we have the usual Singapore weekly and also technical outlook. So without further ado, I will first be starting off with Monte Pacific, Phillip on the ground. So last week we hosted Del Monte for a poems webinar, and I will be covering some main points from the webinar. We do have coverage on Del Monte with a buy rating and a target price of 62 cents, which is based on 13 times PE, and the stock is currently trading at about 8 times. A quick recap, Del Monte is a leading global consumer company, so they produce many different kinds of products. They have the more traditional one, which is the canned foods, and there are also packaged fruits, vegetables, sauces, and juices, as you can see from the picture on the top right. The newest products are the veggie food pocket pies, which is a healthy snack, and also the Joy Bar boba drink, or what we call bubble tea. Valuations-wise, at 8 times, it's quite cheap, but the main overhang for them would still be the high debt and also high interest costs that they have to incur. So for Del Monte, they have 2 main subsidiaries. Firstly is Del Monte Foods, which is the US subsidiary, DMFI for short. This subsidiary first turned profitable in FY21 since the acquisition in 2014. Going forward, growth in revenue and profitability would be driven by penetrating more distribution channels, including the dollar and club stores in the US, and also other channels, for example, entering the fresh section in Walmart. They will also be focusing more on innovation, which the pocket pies and also boba drinks are a result of. Price increases combined with cost reduction initiatives to protect their margins. So in terms of price increase in the first half of FY22, comparing October to April 2021 prices, there was a 10% increase, and there is another one planned for second half of FY22, and that would be of similar extent. So cost reduction initiatives other than automation, the management team also shared about an example on the tin prices spiking. So they use a lot of tin in their cans, and what they could do is to reduce the can's base weight. Basically, that means using less tin per can. For them, high ocean freight prices is not really a major factor, as 90% of the business is domestically sourced. And despite price increases, which they also emphasized is across the whole industry, so it's not only for Del Monte products, they have managed to maintain their market leader positions. So as you can see in the table on the right, this are the market shares that they hold in the US. So they are number 1 in canned vegetable, number 2 in canned fruit and fruit cup snacks. And a reason for maybe maintaining their market leader positions could be partly due to consumers turning to quality brands for healthier food options. So on the Philippines side, which is DMPI, Del Monte Philippines, this is also their most profitable subsidiary. Mainly for this one would be expecting stable growth. So referring to the chart on the bottom right, they have dominant market shares in categories in the Philippines. So you can see number 1 in these 5 categories of up to 91% market share. And this also gives them the ability to further raise prices. The third point would be on their fresh pineapples business, which they export to North Asia, mainly China, where they have about 53% market share. And they are also within the top 3 in Japan, South Korea, and Middle East. So this is a high margin business for the fresh pineapples with about 40% gross margin because there is no processing to do as compared to 13% for branded products. And the plans for the next few years include expanding into tier 2 and 3 cities and entering 2,500 new stores. Lastly, on their debt, so the total debt that they have is now at about $1.6 billion, and that results in annual interest expenses of about $100 million US. So firstly, on the most expensive debt, which is the $500 million loan that they took in May 2020, at 11.875%. It is due in 2025, but redeemable at the option of Del Monte beginning May 2022, which is the start of their FY23. So the management shared that they are expecting to refinance at a lower rate. And if we look at the current yield that bonds are trading, it's about 6%. So if we do some back of the envelope kind of calculations, that would mean annual interest savings of about 30 million. Secondly, would be on the preference shares. So there's a total of 300 million to be refinanced by, firstly, the 90 million 3-year notes raised last month at 3.75% coupon, and the balance by bank loans. So the 3.75% here compares to the rate of about 6.5% for preference shares. So on this, they are also expecting some basic calculations, some savings of about 8 million, but this would be under additional interest cost instead of preferred dividends paid out under preference shares. And for this scenario, that would still give us annual interest savings of about 20 million. So that would mean around a 20% kind of savings. So just a few weeks back, Moody's upgraded Del Monte Foods corporate family rating to B2 from B3, and they quoted the strengthening operating performance, and also with the operational restructuring, they have managed to reduce their debt to EBITDA from 10 times to 4.3 times. This is comparing FY20 to FY21. And we think that this also reflects the higher possibility to refinance at lower rates. And lastly, this comes after S&P raising their credit rating to B from B minus just in October in 2021. So that's all for Del Monte. I will now be passing the time on to Natalie for Keppel DC REIT.
Hello, good morning, everyone. Thank you, Vivian. I'll be talking about Keppel DC REIT's full year 2021 results. Next slide, please. Oh, okay. Sorry, yeah. So starting off with the table on the left-hand side, Keppel DC's full year revenue grew by 2.1%. And this was on the back of full year contributions from two of their acquisitions, Kelsterbach DC and Amsterdam DC, and also the acquisition of Eindhoven campus, which was completed in September of 2021. There was also the completion of IntelliCenter development in July of 2021. Some AEIs also contributed to higher capacity. They include Dublin 1, Dublin 2, as well as DC 1 located in Singapore. For MPI, MPI grew by 1.6%. This is lower than the 2.1% seen in the top line. And this is due to higher OPEX, due to higher operational capacity post AEI at Dublin 1 and Dublin 2. Overall, DPU grew by about 7.4%. Now moving on to the positives. So for the positives, we see that occupancy grew by 0.5 percentage points year on year from 97.8% to 98.3%. And this was due to the acquisition of fully leased Guangdong DC, as well as occupancy improvements at Keppel DC 1 and Dublin 1. Yeah. So Keppel DC 1's occupancy inched up by 2 percentage points to 93.1%, and the manager credits the data center moratorium for helping to increase this occupancy. Okay. Portfolio valuations grew by 8.9%, or 213 million on a same-store basis, and this was largely driven by cap rate compressions. So the Singapore properties accounted for 83% of the valuation uplift, with cap rates compressing approximately 55 to 82 basis points year on year. Okay. IntelliCenter campus, which includes IntelliCenter 2 and IntelliCenter 3, which was the most recently developed asset, it accounted for 17% of the valuation uplift after the IntelliCenter 3 received its TOP. Okay. In terms of investments and acquisitions, so 386 million in investments and acquisitions were made or announced in FY21, and this because of the timing of the completion of the acquisitions and the investments. Two of them, Guangdong DC and Netco bonds, if you can see the table at the bottom of the right hand side of the screen, they were completed towards the end of 2021. So most of the contribution will actually come in it will factor in FY22's results. Okay, yeah. In terms of negative, Keppel DC, so there's about 18.7% of leases by GRI that's up for renewal in FY22, and these are most likely coming from Keppel DC 4 as well as Basis Bay data center. And because Keppel DC does not disclose where the expiries are actually coming out from, we have to use the whales to infer where these expiries will likely come out, materialize. So Keppel DC 4 and Basis Bay, the whale is relatively short, 0.7 years and 0.5 years. And the manager has not yet secured any renewals. They're still in the midst of discussion. But of course, they remain open to divesting if the offer prices are compelling. In terms of outlook, the most recent acquisition was London DC. It was completed on the 11th of January 2021. This is a shell and core asset located in Bracknell, which is within the Greater London area. And Bracknell is dubbed the Silicon Valley of the UK due to the large concentration of multinational technology companies and conglomerates. Okay, so this asset is fully leased to a telecommunications company called Vodafone on a triple net lease until 2039. And in terms of the valuations, we estimate that the yield is going to be around 3.8 to 4.4%. And this is Keppel DC's priciest acquisition yet in terms of yields, is the lowest. However, of course, the manager is optimistic that Bracknell is poised to benefit from spillover demand from neighboring supply-scarce London in the long term. Okay. In terms of other acquisitions, Keppel DC will focus on key data center markets. These include UK, Amsterdam, Paris, Germany, US, and of course they prefer larger acquisitions. That means acquisitions that will most likely help to move the needle and provide more DPU accretion. Just also want to remind everyone that Keppel DC has a ROFR pipeline for the remaining 5 data centers located within the Blue Sea Intelligence Valley. So this area is part of, Guangdong DC is part of this Blue Sea Intelligence Valley. Yeah. Okay. In terms of data center moratorium, there has been no updates with regard to this data center moratorium as yet. However, I think over the weekend the government actually released a bit of an update. They have started to do public inquiries with some of the data center players in Singapore, and they might actually release 3 data center sites totaling about 10 to 30 megawatts of power or capacity. Yeah, so I think more clarity will be expected to come in the coming few months. And the implication of this data center, the lifting of this data center moratorium, would be that there might be more supply that will be allowed to come onto the market. However, the new supply could take 2 to 4 years to come onto the market due to, of course, development timeline, so the management, still remains relatively optimistic, and the stickiness of data center tenants, of course, bodes well for KDC. Yeah. Okay. Yeah, I think the management also pointed out that the lifting of the data center moratorium is a matter of eventuality. It's not if, rather it's about when it's going to be lifted. And when KDC was actually listed in 2014, there was actually no data center moratorium, and so even the lifting of the data center moratorium, it's not expected to. It's not something that they will find to affect them very adversely. Okay. Overall, we maintain our buy call with a lower DDM target price of $2.81. We have lowered our FY22 to FY25 DPUs by about 0.9 to 4.1%, and this was due to the anticipated rising of cost of borrowing. And our target price dips lower because of this lower forecasted DPU, as well as we raised our cost of equity slightly. It was raised from 5.75% to 5.88%. Okay. Overall, the DPU yields stand at 4.8% for FY22 and 4.9% for FY23. So it's one of the more attractive yields when we're talking about Keppel DC, because in the past 2020, 2019, they have, more of 2019, 2018, they've been trading at almost like 3.94 kind of dividend yields. Okay, so that's all for Keppel DC. I'll now move on to Frasers Centrepoint Trust. Oh, sorry. Okay, so this is Frasers Centrepoint Trust's first quarter 2022 update. So this is for the year for the period ended December 2021. So there are no financials that were actually released in this operational update. However, if you look at the table on the left-hand side, this is just a snapshot of the few operational metrics. So you can see the occupancy has actually improved. 2019 levels as 96.5%, and of course the worst was the second column here is actually circuit breaker, 94.6%, and then of course first quarter of 2021 and first quarter of 2022. So you can see a gradual improvement in the occupancy, and in fact the occupancy has actually punched above FY19 levels. Okay. Similarly, we see an improvement in tenant sales from the worst hit, which was 3Q 2020 at 56% of pre-COVID levels. And of course, for the most recent quarter, the average tenant sales has already surpassed 2019 levels. Okay. Now we go on to the positives. So the positive is that retail occupancy was maintained at 97%. So as mentioned, it is above 2019 levels, and 6 out of 9 malls have actually achieved occupancies, very high occupancies between 97 to 100%. There are 3 assets that are laggards in the portfolio. They are Century Square, Changi City Point, as well as White Sands. So for for Century Square and Changi City Point, for Century Square and White Sands, these assets for Century Square, this asset actually is coming out from a very long major AEI cycle that happened in 2018. So that was 2021 was a major renewal year, and because of that, because of the unfortunate timing of this lumpy expiry during the pandemic, this has led to a slower absorption of space. Changi City Point, of course, we know it is located near the Expo as well as some business parks in the Changi area, and this asset received lower tenant demand due to the weaker footfall from remote working, as well as absence of trade shows and events at the Singapore Expo. Okay. In terms of GRI, 14.4% of GRI has been de-risked. This is actually it's only 1 quarter into the new financial year, but 14% of GRI has already been leased out. An additional, so what is remaining for the rest of 2022 is 22.8%, half of which are either committed as of January 2022, either committed or in advanced stages of negotiation. So what we're seeing, what we're seeing is actually a very healthy leasing momentum. November and December tenant sales have reached above pre-pandemic levels. Okay, in terms of negatives, the only office asset within their portfolio is Central Plaza. So they acquired Central Plaza as part of the ARF acquisition, and it is actually located just right beside another asset, which is the shopping mall called Tiong Bahru Plaza. So the occupancy at Central Plaza fell from 91.8% to 71.7%, and this was due to the exit of an anchor tenant, which occupied a few lower floors. So what's going to happen is that the tenant FCT can either look at subdividing the floors and then leasing it out to multiple tenants, or they can attempt to lease out the space to quasi-retail tenants such as clinics and services, kind of trade sectors, because Central Plaza is actually connected to Tiong Bahru Plaza via a linkway on the 2nd floor. Yeah, so either strategy would yield higher rents compared to the rents charged to an anchor tenant. So that means there will be positive reversionary potential. Okay. However, of course, do take note that this multi-tenant lease strategy may result in a longer void period required to lease out all the available floors. In terms of outlook, the return to normalcy is expected to provide a more even recovery among tenants. So while tenant sales have recovered to pre-pandemic levels, the recovery actually varies within and among the trade sectors. For instance, some of the F&B tenants, they have already they have managed to actually achieve sales that are above pre-pandemic levels, due to, as they are more efficient, as they are able to cater to more delivery or pickup orders. However, certain F&B tenants, such as the kiosk and the easy takeaway kind of F&B tenants, that are located along the MRT, or rather the way to the MRT, they have not yet recovered. And so this return to normalcy, return to office, may see a pickup in sales due to incidental spending from more employees returning to the office. Yeah. Okay, and of course, the fashion and other sit-down F&B tenants may benefit from larger group size as well as the resumption of events. Overall, we maintain our buy call on FCT, and our DDM target price is lowered from $2.83 to $2.64 for the same reasons as for Keppel DC, which is because we lowered we increased our cost of borrowing, and that of course resulted in a reduction of DPUs between 3 to 5%, and our target price has dipped lower because of this lower DPU as well as a higher cost of equity assumption. So that's all for me. I'll now hand the time over to Terence.
I can't control. Oh, sorry, I'm just trying to control the slides, but I can't seem to control it. Okay, yeah, it's okay now. Let me just try it. Yeah, I can't seem to control. Yeah, I can't control. I can't control this. But okay, never mind. I just signal. Yeah, but I can't seem to adjust. I think there's a bit of lag on the screen. Sorry, I just start when the screen shows, because I think there's some lag on my side.
All good, Terence. It's at Keppel Corp.
Okay. Mine doesn't show, but it's fine. Okay. So thanks, Natalie. Keppel's second half 21 results blew past expectations, with its results marking a significant turnaround from the same period last year. We provided a summary of this in the table on your right. Net profit for all segments, with the exception of energy and environment, rose. What is worth noting is that when we exclude the impairments from Chris Energy, the segment would have been EBITDA positive. So when you look at the table on your right hand side, you can see that all of these segments actually rose. Sorry, can you give me a while? Yeah, okay. So in summary, I got it. In summary, financial year 21 profit of $1.01 billion was ahead of our forecast, 63.7% above our financial year 21 earnings. The surprise came from its investments in new technology and startups. So if this new technology and this surprise actually came from their corporate and others, if you look at the segment below the subtotal, they recorded a profit of $253 million in second half 21 as compared to losses accumulated over the last 5 years. So this $253 million was a good surprise. In terms of the positives, the net profit was ahead of our forecast, boosted by $303 million in fair value gains. The Keppel Corporation also announced a $500 million share buyback program, which was a nice surprise, and 21 cents of proposed final dividend to reward shareholders. They also announced that the planned business transformation of the group is on track. Keppel O&M and Sembcorp Marine and their logistics business divestment, they set the logistics divestment to have a definitive agreement expected by the end of first quarter 2022. In terms of the negatives, thanks. In terms of the negatives, we were a little bit disappointed by the lack of clarity on the roadmap for SPH acquisition. There was no additional details provided on the timeline of SPH acquisition. So for us, we think that the absence of the timeline will remain an overhang on the stock. In terms of the outlook, we see three positive outlook on the catalysts. We see three outlook on for Keppel Corporation. The main catalyst for Keppel would be the. Sorry, there's some issue with the slides. Yeah. Let me just. Okay. Sorry. So the main catalyst for Keppel Corporation would be the divestment of its O&M unit to Sembcorp Marine. For us, we see the divestment as a potential re-rating for the whole entire group. And the divestment of its logistics business is also expected to be positive for the group. Both events are expected in the first quarter of 2022. In terms of the outlook for the oil and gas industry, this outlook is also improving, underpinned by firmer oil prices. So if you look at the chart here on your right-hand side, you can see that because of firmer oil prices, the outlook is actually has started to turn a lot more positive. Modern jackup rig utilization and the day rates have started to improve for 2021 and is forecasted to improve from 2022 onwards. So you can see utilization at 63%. It's expected to be 73% in 2022. The day rates have also improved correspondingly. So we think it's a good time for Keppel Corporation to divest its O&M unit and we hope to see agreement soon. But we don't have any details. We'll discuss more when they release the details. In our last slide on the valuation of Keppel Corporation, we maintain our buy call on Keppel with an unchanged sum of the parts target price of $7.07. We value Keppel based on its four new segments to better reflect its reporting segments going forward. Yeah, so that's all from me. I'll hand over the time to Timothy.
Yeah, thanks, Terence. Microsoft reported their earnings last week, the second quarter 2022. And they are firing on all cylinders. So all their segments outperformed the expectations. So we just focus on the main growth drivers for Microsoft. So in the first positive, Azure's revenue grew 46% year-on-year versus consensus of 44%. So Azure is, just to remind everyone, is Microsoft's cloud computing business and contributes about 45% of Microsoft's total gross profit growth. So it's a big driver of Microsoft's growth. So the revenue grows much better than expected for above consensus and also above our forecast, full year forecast of 41%. This was driven by continued growth of cloud computing consumption. In addition to that, Microsoft also increased their industry-specific cloud solutions from 1 last year to 6. And these specific cloud solutions help customers to cope with the current issues such as supply chain constraints and the tight labor market. So helping them to manage the supply chain better, helping their employees to work more productive so that they can carry on their business despite the tight labor market. And so these were strong drivers for Microsoft's Azure business. The next growth driver was margins, but we touched on the margins with regards to Commercial Office 365, which is their second biggest growth driver, which is your Outlook, Microsoft Word, all these applications, but it's on a company level, enterprise level. So margins were expanded across the board, and in particular for this one because a lot of their customers were purchasing more premium licenses from Microsoft because the higher premium licenses provided better cybersecurity and compliance solutions. And if you recall, last year, there were in 2021, there were several major cybersecurity attacks that had very big ransoms. And so the momentum from this push into higher premium licenses has continued the past quarter. And so this has pushed average revenue for the users up and provided margin expansion for this. For Azure also, it experienced margin expansion due to improvements across its cloud services, likely due to a larger scale. So they're able to reduce costs for their cloud business. And more surprisingly, their more personal computing segment also recorded higher margins. This is contrary to expectations. In their more personal computing segment, they sell like computers, PCs, all this hardware, Xbox consoles. And these all recorded higher margins despite the supply chain constraints. And in particular, they experienced higher growth in their higher margin segments within this more personal computing segment, such as their Windows software and also search advertising. And this also helped push up margins. So across the board, there was margin expansions. But what really exceeded expectations was commercial bookings. So that's the third positive. Commercial bookings was up 37% versus consensus of only 11%. So almost triple what the market expected. And commercial bookings is basically what customers have said they wanted to spend with Microsoft already. So they have already booked. They already booked some purchases with Microsoft. It's just not recognized yet. And it's a very good indicator of next quarter's revenue growth, in particular for commercial Office 365 segment. So much of the growth from this was because of larger long-term Azure contracts and also because of strong sales execution. So demand is really strong across the board. So it's a very positive results for Microsoft last quarter. There was a slight negative due to the strong USD of 1% on revenue growth. So overall, revenue was in line, but the PATMI exceeded expectations at 58% of our full year 22 estimates. And guidance for the next quarter is also very strong. They guided for strong Azure growth next quarter again, with continued demand from cloud computing, but also continued growth in their Microsoft Office 365 also. Not only from user base driven by small and medium-sized businesses, but also from pricing because of the momentum from demand for premium licenses. So we raised our FY22 earnings PATMI by 4% to factor in the stronger than expected growth. Our target price is raised from 405 to 410. And just to remind everyone, Microsoft is one of the biggest beneficiaries of the secular growth in global digitalization, not only in the cloud, not only in cybersecurity, but also they have so much pricing power in the productivity market that they can increase prices in light of inflation because no one has any other choice but to use the applications. And to top it off, the current issues in the market with regards to the supply chain constraints and the tight labor market and productivity software and artificial intelligence is seen as the most economically viable solutions to this problem. Okay, next slide, please. Is it at Apple now? Okay. Okay, Apple also reported results last week, and they also reported a record quarter, records in revenues, profits, and also margins. So for the first positive, Apple shipments exceeded expectations, and also customers are also purchasing the higher end models of the iPhone 13, and that led to outperformance of the average selling prices of the iPhone segment also. So for shipments wise, they shipped 85 million units versus expectations of 82 million. So they really outmaneuvered the supply chain constraints because of how This is because a lot of manufacturers want to manufacture for Apple because they have the volume, and they also have this. They also sell the most expensive phones around, so they are able to really be very competitive in this supply chain constraint environment. ASPs came in at $844, much higher than the consensus of $833 and of our forecast of $835. So the demand came from 5G upgrading, but not only that, but also from China, which contributed a 5-year high of 21% of Apple's revenue for the quarter. So Apple continues to benefit in China because of the US sanctions against Huawei. Okay, not only did they beat on revenues because of the selling, they sold more units, but also they recorded record gross margins despite the higher costs of elevated transport and component costs, and that was way beyond market expectations. So the record gross margins came in the services segment, which is the App Store, Apple Care, iCloud, recorded a record margin of 72%. And the growth of the services segment also outperformed. So this, because the margins from services is double the product margins, and the growth outperformed, this boosted up the total company's gross margins. So what drove the growth in services segment was their increased installed base. So currently, Apple's installed base of all their devices is 1.8 billion. Actually up 10%, sorry, it's not up 20%, up 10% year on year. And what's helping them is because they're dominating the supply chain. So more and more people, they're able to meet people's demands, and more people are able to switch over to upgrade or switch over to the iPhone, iOS devices, and also use their new iPads and Mac computers and increase their user base. And as the user base grows, more and more people will use their services, and that's where the margins are the highest for Apple. And so this is that's what helping Apple's gross margins increase. But not only services, but also product margins hit 38%, a record margin also, simply because people are buying more expensive iPhone 13s. Okay, there was one slight negative for Apple with regards to the iPad. So it was impacted by chip shortages, but the iPad only contributes about 6% of their quarterly revenue. So the results was in line. The revenue was 32%, PATMI at 38%, but everything was at a record. And guidance for the March quarter growth, they guided for record March quarter growth also. So the guidance was really good. This is despite the tough comparable of last year. The March quarter grew 54% last year. And also this quarter, they also expect 7% headwinds. So despite this tough comparable and 7% headwind, they still expect to record a record. They expect to see a record March quarter this coming quarter. So the guidance is really good from them. So supply chain constraints are expected to ease on a sequential basis. Every quarter, they expect it to ease. And the services segment will also continue to grow strongly at double digits. So we raised our FY22 PATMI by 9%, and this will raise our target price from $187 to $214. So just a reminder, Apple benefits from the 5G super cycle. Everyone is upgrading from 4G to 5G. They also dominate in the supply chain to gain market share and also to deliver on demand. But most importantly is because they are able to price their products ahead of inflationary pressures in the transport and semiconductor segments. Okay, so that's all from me. Pass my time over to Jonathan.
Thanks, Tim. So Netflix put out their fourth quarter 2021 results a week and a half ago. So I'll just go through them quickly. Overall, for the fourth quarter, results were in line with our expectations, and for full year FY21, revenue and PATMI were at 101 and 105% of our full year FY21 forecast. So just a quick glance, you can see that revenue for the quarter came in at 7.7 billion, which was a 16% year-on-year growth. A large reason for this is because of the increases in memberships as well as subscription prices. You can see that PATMI grew 12%, and it was a result of increasing net margins. And paid memberships increased 9% just year-on-year. So for the positives, like I mentioned earlier, strong revenue growth for the fourth quarter. At the same time, earnings, EPS at $1.33 outperformed consensus by about 60+%. And this was due to the increasing net margins as well as a $104 million non-cash unrealized gain from FX remeasurement of their euro-denominated debt. So on to the negatives. Netflix actually guided to a pretty weak first quarter 2022 in terms of paid net additions. So they only guided to 2.5 million net additions compared to 4 million last year for the first quarter of 2021. And they mentioned that there were several reasons for this. One was obviously a continued overhang from COVID. The second was a more back-end slated release schedule. So meaning to say that they're planning for a very heavy release schedule towards the back of the first quarter. So sometime in March, which should affect their acquisitions, or rather their membership acquisitions for the whole quarter. And lastly, also because of several macroeconomic strains in the Latin American region. So they're also expecting a revenue loss of about $1 billion for full year 2022. And this is mainly due to the strengthening US dollar over the last half of 2021. And so because 60% or at least 60% of their total revenue is earned outside of the US, they're quite susceptible to the US dollar fluctuation. And so this, in addition, Netflix doesn't actually hedge against this kind of risk. So this $1 billion expected revenue loss represents almost about 3% of their estimated full year FY22 revenue. Next slide, please. Yeah, so the table on the top left is basically the quick results for the full year FY21 versus FY20. And you can see, revenue growth for the full year was at almost 19%. PATMI came in at 85% year-on-year growth. And this was largely due to an increase in net margins from 11% to 17.5%. Membership growth was strong at 9%, from 204 million to 222 million. EPS in line with PATMI growth, it grew about 85%. Like I mentioned earlier, the outlook was pretty weak at least for this quarter, in terms of net additions. And then obviously you have your expected revenue loss from FX. But we do see that subscription prices, or rather increasing subscription prices in the UCAN region, should offset some of these FX losses. And this was because Netflix actually mentioned earlier this month that they're going to start raising prices in the US and Canada by about $1 to $2. So in terms of our model, we reduced revenue expectations to $33.3 billion. So it's about a 1.5% reduction. We also reduced PATMI to $5.5 billion, and we lowered net additions by about 21%. So from 25 million additions to about 20 million additions. And this is largely in line with the slower growth outlook for the next few years. And so we lower our target price to $673, but we upgrade from an accumulate to a buy, just because the stock price has dropped about 45 to 50% in the last 3 months. But overall, for Netflix, the business is still growing strong. User growth is slowing, but at the same time, the company can make up for that with increases in prices across the board. So with that, I'll now move into TDCX, which is a Phillip on the ground. So TDCX actually did a short guest presentation last week, And so we'll just run through it real quickly. It's actually non-rated. We don't cover it, but they're listed on the New York Stock Exchange. They have a market cap of about 1.7 billion US dollars. In terms of their third quarter highlights, revenue grew 41% year on year, and PATMI grew 47% year on year for the third quarter of 2021. In terms of their business, they've got three main businesses. The first is omni-channel customer experience. The second is digital marketing, and the third is content moderation. In terms of markets, most of the revenue is generated in Southeast Asia, but they do have footprints overseas in North Asia, in Europe, and in Latin America as well. Their main business focus is definitely on their customized outsourced customer experience services. So they currently have about 14,000 employees globally. And then aside from that, they also do have their digital advertising optimization. In terms of customers, they're mostly fast-growing new economy clients. So you think about like Facebook, Airbnb, these kind of companies. These kind of companies are what TDCX is catering their services around. In terms of market opportunity, in Southeast Asia, there's a 10.2 billion US dollar CX market that's growing at 19% for new economy clients. And globally, there's a 80.3 billion US dollar market that's growing at 17%. So some of the competitive advantages that TDCX has is that they've got a multi-geographical presence, meaning to say that especially in Southeast Asia, they've got offices in Singapore, Philippines, Thailand, Malaysia. So it covers like a wide range of languages, first of all, and a wide range of clients. So this is especially important, when it comes to customer experience, because it kind of defeats the purpose if you can't service your client, if you can't understand them. Second of all, they've got a very agile business model, which is to complement the fast-moving industry and the fast-moving clients within the industry. And third, they've got a very unique cultural alignment with their clients. So, for example, if you walked into their office, you feel like you're walking to a Google office or a Facebook office, and they've kind of done this on purpose, just to kind of differentiate themselves from other regular kind of call centers, so that when potential clients walk in, they have a feel that they're still walking into, even though this is an outsourced program, they still are kind of walking into a very similar office that they're used to. So with that, I'll pass my time now on to Warren to finish up with the technicals.
All right, thank you, Jonathan. So I'll just go on to my last presentation of the year. So yeah, so let's look at the STI technical outlook. First of all, I think the 3002 resistance curve has been removed tentatively for now, as price has made a higher high upon, and then last last Thursday, in fact, it has closed. 2 weeks ago, it has reached its target high above 3003 briefly. Despite currently despite evening star kind of formation, and with a bit slight of divergence, we believe that there will be a price, there will be a slight correction. We releasing 3002 psychological support, or maybe 3190 region over here. Okay, so reason why is because looking back of an overall chart, prices have been making a series of higher high, higher low, and higher high, higher low. Panel has broken out, and then price has been ranging slightly higher on a higher note. Okay, so regardless, I think if you look at the support, the bull trap over here, price came down, rebounded at the 3,100 and 3,3054 region, making a higher low, and in fact, price rebounded strongly, and we form a two strong bullish full body candle is citing a very strong bullish market going forward. So if you look at the Elliott wave theory, the sub wave, you can wave 1, wave 2, wave 3, and then wave 4 at 3002, and then wave 5 will be targeting at 3000, the high end of 3003, or perhaps even at 3004, which confluence with the 3444 and this level at resistance zone 2. Moving forward, I think if you look at the daily chart, shows a much clearer picture. Despite prices breaking below the Tenkan Sen, we believe that the uptrend of the SDI is still valid. First of all, you can look at the symmetrical triangle has been broken on the upward basis, so it signifies that a new bullish trend has come forth, signify a new beginning. Okay. But despite that, I think price always what goes up has to come into correction. So we believe that this wave 1, 2, and 3, I believe that there'll be a elaborated kind of correction, a very sub deeper correction to 3195, which I mentioned during the weekly chart earlier on. So, but Kumo bullish trace, everything is still on. So, in fact, we think that price is going to rebound on the upside. Moving on, what I'll be sharing some of the counters that has a best technical call. One of them is Sembcorp, but unfortunately I didn't have that. You can go to Stock BNB and type Sembcorp Industry, not Marine. Okay. All right. So price for Hourglass, I think you can see that it has broke out the pattern, and now it's on the falling wedge, despite prices breaking below the lower Bollinger band 6, citing a bearish downtrend. But price quickly rebounded with a bullish hammer, and followed by a confirmation with a bullish candle over here. Okay, so currently I think the price is let me check the currently the what's the wait, give me a moment. For Hourglass, I think right now, wait, give me a second. Okay, so price actually went up. Highest was earlier on was at $1.92. Last Friday was $1.89. So we believe that there's a short-term targeting of 1.955 to 1.99 region over here. So should it successfully break above, so it means that it confirmed the falling wedge pattern. Furthermore, if you look at the fractality of the Hourglass, you can see that the pattern actually resembles the falling wedge. So you can see that a strong up move followed by a consolidation in the pattern, a corrective pattern, and a strong up move right now, and then falling back. So I think there will be a replication of another stronger upside up move perhaps in this manner. And you can factor in this smaller one is actually a corrective pattern, and so on and so forth. Okay, so the next one will be for the Hong Kong and the US, which I'll share later on, is on the oil sector, energy sector. So why did China Shenhua actually went up all the way? Is because other than the technicals, I think the fundamental of like the oil prices and is nearing the winter. So oil prices technically overall at the end of the year is energy prices tend to soar, and true enough, I think oil prices soar. It brings a lot of this kind of energy related companies back to a new high. So in fact, when I was issuing this report in October, you can scan over here on the QR code. Price actually make a new high, but it wasn't sustenance. It came down. There was kind of like RSI divergence, bullish hammer followed by a confirmation. We test the support zone, bullish engulfing, and then we went up all the way and stuff like this. So right now, despite prices close below Tenkan and Kijun Sen, and Senko span is remaining flat. So we believe that there may be a longer term trend. You'll go to support term resistance at $70, $18.32. So this all for China Shenhua. The next one, the last slide, will be on Marathon Petroleum. So together with Oxy Petroleum, I think for Marathon, uptrend line and the bullish flag and a hammer, it retested and then prices went up to the upside, testing again. So prices still maintain its edge despite a doji near the Tenkan Sen. Upside is still on, so we believe that any target will be targeting $77.50 in the longer run. And with that, and should $75 become a key selling zone, we believe that there's one more downside to test $67.71 before a rebound. So it's like a three-way pattern. But either way, I think that $75 is easily going to be broken moving forward. So with that, I pass my time to Paul to share the Singapore Weekly. Paul, over to you.
Thanks. Next slide, Viren. Before we start, just want to wish everyone a healthy and prosperous year of the Tiger. In terms of some of the the core things. I won't run through everyone, but in terms of the CPI, we'll just show you a chart later what it actually means, which I think is much ado about nothing. But in terms of the employment numbers, I thought that was more important for the market. There were 54,000 additional employment in the fourth quarter. It is positive for two stocks, HR Net Group, and it's also positive for building materials because we've finally seen a rebound in construction workers. We'll show you a chart later. The other one was also, there's a lot of news on development data units sold, but we wanted to focus more on the inventory. And we noticed that the developer inventories have dropped to a kind of record low. So there's only like 1 year or 1.5 years of inventory based on the current sales run rate. No, because our run rate refers to either you're selling 10,000 or 13,000 units a year. But what it also means is that it will be supportive of property prices. And in a way, the developers have kind of de-risked because they basically sold out most of the inventory. So that will be a positive for the developers, I mean, based on the industry data. We all know about the FOMC meeting, but having listened to almost the whole thing, I guess the three key parts to it was firstly, when questioned about whether there will be a March 21 hike, I think his actual words were of a mind, but I mean the press read it as he will hike rates in March. The second message was that when asked whether he will hike interest rates in all the FOMC meetings, every year there are 8 meetings, so there's 7 left. He didn't say no, but the market read it as just basically a yes. But actually, he just said that I don't think it's possible to actually say yes. So actually, he's not even not fixed yet on whether there's going to be 7 hikes. But now the range is 5 hikes to 7 interest rate hikes for this year. The other thing that the press is also speculating is there's going to be a 50 basis point hike in March, which is highly unlikely because if they want to do this, they will normally want to communicate. I mean, this Powell is someone who likes to communicate a lot before the hike. So he has never actually mentioned 50. So I think that's more like the media speculation. So basically, there's these 3 things. So March, there's going to be a hike. Unlikely to be 7, we think probably more like 5. And there's not going to be a 50 basis point hike. In terms of our view, we still think it will be sideways. I think the market is now trying to absorb or framing for 4 to 7 interest rate hikes. The futures market is pricing in 5. Nevertheless, all this is going to be good for the banking sector. So again, our view is that until inflation kind of tapers, it's going to be a very risky for the market because it's indefinite number of hikes. And we worry as you move on, then you get this yield inversion and then the market's going to drop because you're going to be worried there's going to be, hopefully it doesn't invert, but once there's an inversion, that means it kind of slides down, then there'll be worries of a recession again. We'll show you a chart later. And the worry thing is that even the Federal Reserve have 400 PhD economists and they can't even forecast inflation. So it's going to be a bit of a big uncertainty whether inflation can taper down. But I mean, we are hopeful because so far, commodity prices and some of the supply chain barometers are starting to slip. So hopefully that can bring down the inflation. I think I'll skip this. All this is for you all to see. I think there's Google's results next week. And also this is some of our webinars. Next slide. Okay, this is just to show you the global COVID cases as we show every week. The only thing is that just the mortality rate is starting to climb back up, which is the red line. Next slide. We won't run too much. This one is, I think we know this. I guess the wave is coming up for Singapore. You will look at the blue line, and hospitalization is also climbing up. So that's not a good thing, obviously. Next slide. So in terms of based on the recent labor data that is out, you can see on the left, there's a big jump of services of 30,000. The one on the left is services jobs. So that means every quarter, what is the addition and what's the deduction? So for us, this is good for or supportive of HR net because they are mainly servicing the services sector. The one on the right is just the construction, the number of workers in the construction industry. So you can see that the net additions, the total number. So you can see there's a big bounce in construction and the VTL lanes into Southern Asian countries. So this is going to be a positive. We need this so that construction activity can return. There's a 16,000 jump It's still down 48,000, but it's still recovering nicely. So this will be a positive on construction, especially for the building materials. I mean, these are the two, I guess, from the recent labor, this is what's going to be useful. I think the useful data points on this. Next slide. Okay, this is just to show you the inventory of the developers. The red line is basically inventory to the 12-month sales. That means, for instance, if there's 10,000 inventory and last year's 12-month sales is 10,000, then that means you only got 1 year of sales. That's how we calculate. If you use 13,000, which is last year's a bit high, it's 1.1. Even if you use 10,000, which is not the average number of units sold, it's still very low. So developers' inventory is very low, and you can, it depends how you want to spin it. That means they either have to rush and bid for more land, or they kind of de-risk and sold out most of their projects, and they don't have to be too aggressive in bidding and get the better pricing. Again, this one is depending how you see, whether glass half empty or half full. But I guess for us, we think that is a positive because they more or less de-risked. Next slide. Okay, this one okay, this is very complicated chart. I won't run in view of this Chinese New Year Eve, but what we're just trying to say is that if you look at what you always see in the media is always the blue line, which is the nominal effective exchange rate. So this is the line where it's against Singapore dollar against the basket. But when you look at the red line, which is the Singapore against US dollar, there isn't really much of a move. So if you look at the middle, the last time we raised, it means increased slightly. The nominal US dollar is going to be weakened against them. They did it actually. The US dollar actually strengthened against us. Again, I won't go through too detail for this, but yeah, just for your reference. Next slide. Because it doesn't really affect the equity investors. Next slide. Sorry, just bear with this, a bit of a lag. Okay, this is my last slide. Yeah, so sorry, I'm not sure what's going on with the internet connection, but okay, for this slide, I guess this is probably the more important slide. Again, very complicated slide again. So the blue line is the stock market, S&P. The more important line is the red line, which is the Fed funds rate. And then the shader is recession. So there's basically two messages here. And that's why the market can be a bit worried when the Fed rate rises, because you can see that when the Federal Reserve is on this path of raising rates, which is the red line, a recession can happen. You can see the last three green circles, right? When the Fed keeps on raising rates, then you hit into this wall of recession, which is a shaded line. So this is the risk. It didn't happen in 1994. If you look at the green ball on the far left, the one on the left, it's basically because the Fed actually reverts a direction very fast. So the worry right now is if the Fed keeps on raising rates, I don't know, 7, 8, 9 times, the next 2 years, you might trigger a recession, which is the shaded line. Okay, so this historically is going to worry the market. And the second point for this chart is just that if you focus on the yellow, it's the yellow, which is basically inflation. What I'm just trying to say is that the Fed funds rate is typically higher than inflation numbers. So if they want to push it, this can be really steep. If you look at maybe 2008 and before, you can see that the red line is always above inflation, which is orange line. But since the GFC has been below, so what we're just trying to say is the other risk is that if they want to push rates, Fed funds can actually be even higher than inflation, which we know is at 4 to 5%. So that's why the market is very nervous. Then the Fed is on this kind of aggressive move. Okay, I hope. Sorry for earlier the SGD. I saw one comment. Next slide. Okay, next slide. Sorry, there's a lag here. Are we on the next slide? The Suntec one.
Nope, not yet.
Okay. Okay, this is the last slide. Yes, sorry, everyone. I need this New Year's. Let's get this done with. Okay. Anyway, this is Phillip on the ground. What we just wanted to show. Okay. I won't run through everything, but basically what has happened is that I think the rest you can read. But what we just wanted to share in view of time is that Centec. I mean, at least for me, it looks attractive. Firstly, the price to book right now is about 0.7. Which is the red line, and prior to this, it was 0.9, even one-time price to book. If you look at the red line, the share price is now 150. So it's interesting because you won't get this type of valuation if there are no issues, obviously. And the issues is just that there isn't, because they don't have the convention and they don't have the weekend crowd. Just to give you a flavor, if you look at the fifth bullet point, the Suntec Mall, pre-pandemic, the crowd is about 100 to 140,000. Now it's about 95. So what is happening? They miss the tourists and they miss the convention crowd. So I mean, if you take the view that eventually this issue will return to the norm, then I think this stock kind of looks attractive. I won't run through all this. The rest is self-explanatory. But if you have any questions, I'll run through. Just that in view of time, I think we can just go straight to Q&A. Yeah, I think Viren, you can go first. I think a lot of technicals.
Okay, no problem. I'll start first. So just give me a moment. I need to prepare my slides. So perhaps Natalie, you go first. Is it possible? Yeah.
Sorry. Okay. Okay. First question for me would be: will the correction in Singapore listed REITs continue due to the announced US rate increase? I think the answer is yes. Because initially coming into 2022, sorry, we already know that there will be rate hikes, and then initially it was 4. I think now some are speculating 5 and even more. So as and of course initially it was, I think, 100 basis points, and that number is also increasing. And as the interest rates, as the Fed rates go up, that will also have an implication on our own Singapore rates, and of course that will impact the cost of borrowing and result in a higher cost of borrowing and then a lower DPU. So I think as the view of interest rates, or rather as we have more clarity on how the interest rates progress, especially if it was to continue rising, then progressively the market will start to price this into the REIT share price. Yeah. So my answer is if the rates continue to rise, then yes, I think the Singapore REITs will continue to be revalued downwards. Next question for me would be: any idea why Keppel DC REIT, Mapletree Industrial Trust, and Ascendas REIT containing data centers in the portfolio, the share prices for all these 3 companies are falling, yet Digital Core REIT, which is also a data center REIT, the price seems to be held steady. So first of all, DC Core REIT, they were listed in December, so it's only a short about one and a half months of trading history. Yes, it's true. If we look at if we look at the year to date, meaning since end December, or rather since 2nd January until now, Digital Core is also actually down very mildly, 0.8%, if I'm not wrong. And of course, that compares to the likes of Mapletree Industrial, which is down by about 7-ish%, Keppel DC down about 13%, Ascendas down about, I think, 7-ish% as well. So I think there's a little bit of differences between the REITs, even though they all do contain data centers. So for Digital Core REIT, we start off with that first. DC Core REIT, they actually have very low cost of financing, 1.1%. Unfortunately, for those of you who might not be aware, this 1.1% is 100% floating rate, which means that as the interest rate rises, it would immediately be priced into the cost of borrowing because it's all floating rate loans. But one thing going for Digital Core REIT is that they have a very low initial gearing, which is 27%. So this was actually done intentionally because they want to demonstrate their ability to acquire from the sponsor's ROFR pipeline. So this gearing is definitely expected to go up. And this 1.1% cost of borrowing is not forever. as I mentioned, it will go up, and but I think the REIT will also look at how they can start to hedge some of this interest rate. And of course, hedging is not cheap, especially in a rising interest rate environment. Yeah, so this 1.1% is not forever. But the catalyst for DC REIT would be, of course, the acquisition story and its present low cost of borrowing. Now moving on to Keppel DC REIT, Mint, as well as Mapletree Industrial Trust, as well as Ascendas. So for Keppel DC REIT, which is the most impacted amongst the three names, my gut feeling is that the reason why Keppel DC is more impacted is because of its higher proportion of data centers located in Singapore. About 70% of their data centers are located in Singapore. And while there's no clarity on the data center moratorium in Singapore, we do know that it will be lifted eventually. It's just a matter of when. And there's already talks that another 10 to 30 megawatts of capacity might be allowed, might be approved for construction, in the coming year, and that might, of course, then become a competition for Keppel DC REIT. So I think that was the reason why Keppel DC is a little bit more impacted, and as compared to Mapletree and Industrial and Ascendas REIT, because these two are still more diversified kind of REITs. While yes, Mapletree does have a relatively significant portion in data centers, mostly US data centers. These two REITs, Mapletree Industrial as well as Ascendas, they are more diversified in that sense. But yeah, but overall, if you look at the trend amongst the S-REITs, they have lost a bit of their share price coming into this new year, and also largely because of the rising interest rate expectation. I also saw another question related to data centers. Okay. What would be the implication on Keppel DC if the QPDS is not approved? So thank you for this question. This QPDS actually refers to the investment in Netco bonds. So Netco bonds, if it was a business trust or a regular company that's actually investing in bonds, is actually interest rate, rather is tax exempt for this interest on the bonds. However, there isn't this exception for REITs, and that's why Keppel DC actually needs to apply for this QPDS approval so that they do not have to pay this 17% corporate tax. So currently, as per their latest update to the investors, it has not been approved yet, and they are in the process of this application. And if this QPDS is not approved, then it will have a very small impact to DPUs. It will impact DPUs between 0.6 to 0.8%. So it's very minute, and that will have about a 2 cent impact on DPU. So it's actually very small, the impact. Okay, I hope that answers the question. Sorry, this other question, which of the three, Keppel DC, Mapletree Industrial, and DC Digital Core REIT has the highest upside potential when SG lifts the moratorium on DC construction? So as earlier mentioned, the raising of the moratorium will actually bring on more supply, which, some might argue that it's more competition and, maybe less pricing power for the data center REITs. However, if you talk about upside, from what the management has been communicating to us for Keppel DC, they prefer stabilized kind of assets. They do not really embark on development type of assets because they do not want to impact the DPUs very much. So I think Keppel DC has more of a conservative approach, whereas Mapletree Industrial Trust, they have looking at the track record, they have actually embarked on this kind of redevelopment, and also given the larger portfolio size, they can withstand undertaking these kind of redevelopment or development projects. Yeah, so I would say that amongst the three, Mapletree Industrial Trust would potentially be the one that might benefit from this lifting of data center moratorium, because I think that they might be more inclined to pursue this kind of contracts, or tender for developments. As for the Digital Core REIT, this digital realty is mostly the assets are mostly in the US and other developed markets, and not so much in Singapore or Asia, or rather the Asian assets are still under development. So I would say that their expertise in terms of building in Singapore is they don't really have the expertise. In fact, So I hope that answers the question. I would say maybe choose the answer. Okay. Sorry, let me just go through the questions so that I can. Okay. There's another question here. What is the cause of Ascendas REIT's share price decline in share price? Is there a new target price for Ascendas REIT? So earlier I was in my presentation of Keppel DC as well as Frasers Centrepoint Trust. I actually imputed a higher cost of borrowing as well as an increase in the cost of equity for these two counters, and I would expect to do that for the rest of the S-REITs under my coverage. So and generally an increase in cost of borrowing as well as the cost of equity will reduce the target price. So I do expect that my target price for Ascendas would be moderated downwards slightly. As for why is Ascendas REIT share price falling, I would say that it's largely it could be due to two reasons. The rebalancing into reopening counters, as well as of course the REITs are impacted by the increasing interest rate environment, or rather the anticipation of the rising of interest rates. So actually across the board, the REITs, all the REITs are affected. It just depends on the degree of share price decline. Okay. There's another question for me, but let me go and consult my charts before I take it up. It's about interest rate yields. So I'll just pass the time back to my colleagues for now.
Hi, dear. My dear colleague, can I start to do a Q&A first? Yep. Okay, I think that's okay. So first of all, the question is on JD.com. So for JD.com, like I mentioned last week, this major support zone has rebounded, and then as a deeper correction after a double top failed to reach above the resistance zone at 315 to 324. Followed by a correction, but these V-shaped rebound kind of like go throughout with my trajectory. Rebound was at $260 psychological resistance, psychological support. Sorry. And then if you look at the wait, give me a moment. How do I? Okay, so if you look at the Fibonacci retracement, it actually land nicely on the 78.6 deeper resistance. Also, it kind of like confirmed the going upside of that. So despite that, I think the need to close above 284 will be a better a confirmation going forward. But nonetheless, I think that we are on the trajectory back to the upside target 315 to 324 resistance zone 1, and then subsequently 360. Looking at the weekly chart, you can see that this one is like a kind of like a V-shaped rebound going up, and then we are going on to a larger N wave going on for 1, and then 2, and then 3. That will be a super long run in the future. All right. So looking at JD Log, JD Log was previously like, I thought of a head and shoulder that breaks to $27.50, but unfortunately it doesn't. The DM minus is going strong with the ADS crossing. So bullish trend is unlikely to come for now. All right. So for JD Log, we are still on a downtrend, and renewed bearish crossover. Yeah, is showing any upside is likely to face a tough resistance at $25. Means that $25 will be actually a key selling level that to be observed. All right. So next one is ABC Agriculture Bank of China. I think the Hong Kong banks, all these, including China Merchant Banks, Bank of China, ICBC, all are raging on the bull. Right now, despite a divergence from RSI, price came back with rebound, break above the 10 cents. So the next level we're going to break is $2.99, and then we can, if shall it break, we shall target $3.10 in the longer run for that. 9988 9988 yes, this is a very good number for Chinese New Year, but unfortunately the trend doesn't show it this way. Despite a triple bottom that initially was a double bottom, breaks above, but price came down. I forewarned that 135 to 141 is really a tough resistance to break. Despite that, there is a bearish crossover. Rebound wasn't that strong, so we will see that 124 to 127 will be a resistance that is tough to break. Price may come down on the downside again. All right, so just beware. Will we find bottom for Alibaba? You can take a chance, and then but 135 really is a strong resistance to be remarkable. Even if it breaks the gap zone over here at 151 is really, you really need to be very careful on that. Singtel divergence, double top, slightly high engulfing candle that confirms it. So likely there will be a chance that breaks down forward. Next support will be at $2.35 to $2.32 for rebound. So should this level fails, I think there will be a trajectory like this. So be a rebound and then going down to a forward and $2.23 going forward. DBS is right now the corrective kind of range. I think $34 must be supported. If not, the chances are there will be a further downside to $32.69 before rebound. Okay, so nice CI last week I shared that there's a pattern, but unfortunately the pattern didn't really play out. Prices did a three-wave pattern, corrective pattern. So in this sense, I think the wave 2 is not completed yet. So we believe that there will be an expansion level to 1.272, which is $3.38 to or $3.30 at 1.618 moving forward. U96 Semicon Industry was one of my best call during that time. However, I think that tweezer top and double shooting star pattern may force prices to retest at $2.17 or a deeper correction into $2.06 moving forward. Prices are they briefly break the new high. So if it return back, I think $2.70 at $2.06 is the best level to work out for. Let me see, is any 202 IFAST. Let's do an IFAST target price. Okay, so IFAST has already breaks come back to the support at $6.49 region. So I think IFAST the upside is a very strong. So momentum wise, I think you can see that ADX the DMI is going on very strong bearish correction. So $5 will be likely the next target going forward. Okay, weekly chart, you look at the longer term weekly chart, I think we are seeing a $5 rebound, and then there will be a very strong correction definitely. Okay, breaking out of the falling wedge. So right now we are in a strong bearish trend for that. All right. So that's all for now. I pass my time back to Timothy. I'll answer on the activation visa. All right, thank you.
Yeah, thanks, Aaron. There's one question about Microsoft's acquisition of Activision Blizzard. Hi team, has your target price for Microsoft factored in the impact from this acquisition? Do you think it will affect Microsoft's performance going forward? Okay, the acquisition has just been announced only, so it will only be approved, completed roughly around June next year. So we haven't modeled it yet into our target price. But overall, Activision will only raise Microsoft's revenue by about 5%. So that's if that's like the magnitude of the impact from this acquisition. So yeah, not that significant. Yeah. Okay, that's all from me.
Yeah, I'll probably take the next question. Can explain if divest O&M is good for Keppel. Does it mean Sam Marine shareholders getting a rubbish company again? So I think there are two parts to this question. I'll address the first part, which is whether the divestment of the O&M is good for Keppel. We believe the divestment of the O&M business is good for Keppel because for Keppel, they are a conglomerate. So they have multiple business lines that they can focus on. So the O&M business has been a drag on their balance sheet for a very long time because it's capital intensive, and the downturn also resulted in a drag on their balance sheet. For Keppel, the divestment is a good opportunity for them to divest off the business, realize some cash upfront, and then use the capital to focus on the other business areas that they have, because they have many different business units. So the O&M business can be a bit of a distraction for them as well. And then also the divestment will also lead them to reach their ROE, their 15% ROE target faster as well. For Sam Marine, they are not getting a rubbish company because the Keppel O&M business is actually profitable already profitable on the EBITDA level when we strip out the Chris Energy impairment. So the Keppel O&M business for this year, they also drew in about $3.1 billion of new orders. So they have an order book of about $5.1 billion. So that's huge. That's significant compared to the orders that they are getting there. So for Sam Marine, they are getting a very solid company from Keppel, from Keppel. And the rationale for this merger is not so much for Sam Marine shareholders to get to get a rubbish company like what you say, but it's because in this competitive landscape, it doesn't make sense for Keppel and Sam Marine to be competing in the global market against each other. So they should be consolidating their strengths to compete for contracts on the international stage. So there will be cost synergies for Keppel and Sam Marine, and then there will be revenue synergies because they are not competing against each other. So we view the merger when it happens as positive for both Keppel and Sam Marine. Yeah, that's all from me. I'll hand over the time back to the rest of my colleagues.
Okay, thanks. Let me just try to answer some. Propnex, is it overvalued still? Or are the dividends likely to be retained? So the profit, just to give you some context, the profit, because this year's profit is going to be spectacular as well. I think about 70. I think our forecast is. But prior to that, it was probably around 30 million plus. So if you assume that transaction volumes go back to 2020 levels, which is quite reasonable, I guess. You're talking probably, and they pay out everything which they can because they have like 100 million cash. You're talking about a 5% dividend yield for the company. If they were to pay all the profits, assuming which is reasonable, it goes back to FY20. Is it overvalued? I don't. It's more like uncertainty because the next 6 months is going to be tough. I mean, you cannot hide from that because the transaction volumes are going to plunge. The most likely scenario, resale, the bid-ask spread is going to be widened. So that's why we think it will be a bit of a lull for them in terms of volume. There will be unlikely to have any momentum in the next 6 months because transaction volumes are not going to pick up. Yeah, there's a lot of cautiousness and so forth. Yeah, I hope that answers it. Yeah. Sorry. Hi, Paul, do you have any comment on the recent weakness in share price of IX Biopharma and UG? thanks. So for IS Biopharma, they did a webinar with us. I didn't present it because it was really nothing new, but everything is progressing. There are multiple drivers for this share price. So but some of them are just a bit long. So the main product, wafermin, just call it the pain product. It needs to complete phase 3 trials, but that's like 1-2 years away. Then number 2 is their so-called Viagra wafer seal, the Viagra type one. So that is also progressing, but it's pending registration with China. But they've got like the 3rd largest Chinese pharmaceutical to help them. So that's the second driver. The third one is the Hong Kong listing, which they say is progressing, but all this takes time. And in the sidelines, they are working on a few more some dimension. I think so there's a few more products. Sorry, just slipped my mind. There's another 2 or 3 more new products that they're working on. And then the 4th driver would be their cannabis product, which if they can get US distribution into the US, which they're trying to now, and into into the US especially, then that will be the next driver. Just that some of them, because this stock is all about news flow, it will probably, some are longer term news flow, some are shorter term. So the shorter term ones will be probably the Hong Kong IPO and the cannabis product. In terms of the weakness, I mean, if I had to pinpoint anything, it will be because, dialing back to the pain product, sorry, it's a bit confusing for some, they don't follow, but the pain product where they sold out licensing, where the revenue can be, a couple $100 million. I think with the sell-off in Nasdaq, so I mean, you can just say that the tech sentiment is affected. So this company, they took they're sticking their pain product. I mean, the share price was so low. So I mean, you can also argue uncertainty whether they can raise money and all that. But they've raised before. So that's probably the one negative out there. Yeah, so it's a very long answer. But okay, you go on to UG Health, which is the rubber glove. There isn't any. It will be challenging for all the glove makers because after the last 2 years spectacular jump, everyone was increasing supply. We also know Aspen, the property developer, also decided to go into rubber gloves. So I mean, everybody went to rubber gloves. So as a result of that, there will be a bit of oversupply in the production. But what will help UG differentiate from the rest is because they are doing distribution, because they got production and distribution. So right now, the bargaining power has swung. So distributors are actually gaining the upper hand. They can get better margins. So this will help them. So I guess that's the recent update. But in the meantime, I think production, it will be, I guess, some gestation. It probably take at least another year for the supply. When everyone will start tapering, everyone is cutting back on their supply plans, production plans, and then demand has to catch up. So this happens all the time for rubber, but just that there'll be a bit of a lull for the next maybe 12 months. My own thoughts. Okay. Any update on Uni Asia? I'm not sure if even you got anything to update there. Any advice on nanofilm? I don't really cover, but I think what happened is that the market has been cutting back. I didn't go to any call. I didn't get to the update, but I believe what happened is that the market's all revising down the target price, revising down their forecast, mainly because their expenses has been much higher than expected. Yeah, so I think if you go across, the market had to revise their expectations of that. So it could be maybe more of a short-term thing because cost is more that they're guiding down their profit. So that's why the share price got hit because of higher than expected expenses. That's why that's all I know, because they didn't do a briefing, maybe because I don't cover that. Yeah, maybe bad news, nobody want to do a briefing. Okay, I'm not sure if anyone else we got any update on SunPower and Uniasia?
Hello. Maybe not for UniAsia, maybe on the SunPower side. Could you share your latest on the SunPower with reference to its current share price? Not much update we have here. So the last time they released the result was for 3Q, and I think there will be a clearer picture for the next results release, which would be next month. But I think the major thing for them would be the fact that the main raw material for them is coal. And even though the coal prices have fallen from the peak when it was around 5 times the kind of like normalized levels, but it's still quite elevated. So we saw the impact of higher coal prices on their cost of sales in 3Q. And I think in 4Q, there will be a clearer picture of whether they would be able to pass it on to their customers 100%. So yeah, that's all that I have for SunPower.
Natalie?
Okay, so hello? Okay.
No, sorry, go ahead. I think what we will do, sorry to interrupt you. What we will do is we'll probably show you all a chart in between how the S-REITs index has performed when the Fed funds raise their rates. Yeah, so I think Natalie will probably do that. There are a lot of questions on interest rates.
Yeah. Okay, just a very quick one on this. Probably the question is, what is the optimal yield spread between S-REITs and 10-year SGS in a rising interest rate environment? How much more downside in terms of S-REIT share price are we anticipating in the next 6 months? So I think the yield spread, it has gone to as low as about 2% yield spread, and even sub 2%. In terms of so I think in the coming weeks, monthly, we'll probably do a more deep dive on this interest rate environment / inflationary environment. So I think that's all for me. I'll let Paul do the closing remarks.
Okay, so thanks everyone. Wish everyone a happy New Year. So this unit issue we don't really follow. I mean, apart from it benefiting from the Baltic Dry Index, but the problem with Baltic Dry Index is basically a China story. How much iron ore, how much coal they import. So that might have probably peaked. But again, we're not really that familiar with unit issue. The next one is any China bank you recommend. Sorry for that question. You might have to ask our Hong Kong office. But in the meantime, wish everyone a good year ahead and wish everyone a big hot for the year of the tiger. Thanks everyone for your questions and especially for your time spent with us. Throughout the last couple of weeks or months. Thanks everyone and wish everyone a healthy and prosperous year ahead. Thank you.